Welcome back to the KingCast. It has been a while. We are presented by the King Economics Division of the Social Sciences Department. I'm your host, Frank Roach. With me today, Lily Ryan. Good morning, Lily.
Good morning.
Nicole Roer. Hi, Nicole.
Good morning. It's good to be back.
Great to have you back. And Jake Murphy with a new light on his face. Looking good, Jake.
That's right.
Good to see you. Thank you for the technological upgrade. All right, so we haven't been together for a while, right? So just so our audience knows, if we have a day off from school on a Friday or Monday, we don't record. In the interest of the students, giving them free time, travel with their parents, relax, sleep late, whatever it is. And so that's why we haven't been around for a while. But on our first show back, we have a fantastic guest. What a get this is. Mr. Dean Maki, Chief Economist at Point72 Asset Management here in Stamford, Connecticut. As always, we're excited to be back with another KingCast. I hope you enjoy it. All right, we start off like we always do with hot topics. Nicole, you've been taking a look at what's going on with valuations around the financial markets. Why don't you tell us what you found out?
Yeah, thanks, Mr. Roche. As financial markets continue to move higher and fair value is an ever-changing concept, I thought I would revisit the latest thinking on the stock market valuation. In previous KingCast episodes, I suggested that the market was due for a correction. I discussed yields jumping above 1.5% on the 10-year benchmark treasury debt, as well as noting that the dividend yields on the S&P and 10-year were at the same level at around 1.5%. Both of these indicators suggested the potential for inflation and that money could come out of the stock market and into the bond market with increasing yields. I also mentioned that the forward PE multiple on the S&P at 22 times appeared to be at the same level as the peak of the dot-com bubble in September 2000. There are also tax hikes expected from the Biden administration. Further, the rally in SPACs, meme stocks, and cryptocurrencies suggested that things were getting frothy. And don't forget, the pandemic is not over yet. However, I have done some additional research on these points and am now less sure that the market is overvalued. The reasons for this are Treasury yields have moderated, and while 10-year peaked above 1.7% briefly, the yield has been holding steady at 1.6%. While some feared that the yields on the 10-year could go to 2% or higher, others noted that Japan could turn from being a seller of treasuries to a buyer at these higher levels, and therefore put the brakes on the yields continuing to rise. Scott Miner, the Global Chief Investment Officer at Guggenheim, went even further, stating that interest rates are still on a downward trajectory, and he still expects them to go negative per their internal models that project interest rate trends. I also started questioning whether PE multiples are truly at the same levels as they were at the height of the dot-com bubble. The price component of the PE multiple is clear. It is the price at which stocks trade, but the earning component of the PE multiple is less clear, particularly when you are looking at it on a forward basis, which is just a projection. As the economy has continued to improve, earnings projections have been going up as well, which results in lower PE multiples, with earnings being in the denominator of the ratio. Same is true for forward price to sales ratios. As sales projections go up, the price to sales ratio comes down. So perhaps the multiples that are showing the market is at the same level as the dot-com crash are not properly reflecting forward earnings and sales projections. There's also the infrastructure plan recently released by the Biden administration, which involves spending $2 trillion on roads, bridges, climate change, and racial inequality. This significant deficit spending by the government should continue to spur economic activity, although it comes with increases in corporate tax rates and the long-term impact on the US debt. Ultimately, as long as money continues to flow into the market, stock prices will continue to move higher. This is based on the simple principle of supply and demand. Greater demand for stocks pushes out the demand curve and the equilibrium price of stocks go up, assuming the supply of stocks stays relatively constant. And more money has come into the equity market in the last 5 months at $569 billion than in the last 12 years at $452 billion per Bank of America. Many market prognosticators have been predicting that the market still has many tailwinds to keep going up. Jeremy Siegel, a finance professor at Wharton, said this past week that the market could go up another 30% or more before it pulls back. He said, "We're not in the 9th inning, we're more like in the 3rd inning of the boom." I talked about the roaring 20s in a previous segment of KingCast, and Siegel certainly sees that coming as pandemic restrictions are lifted in conjunction with an accommodative Fed with low interest rates. Likewise, Jamie Dimon, the CEO of JP Morgan, has said he can see the economic boom continuing into 2023 with more government spending and achieving herd immunity with vaccinations. David Kostin of Goldman Sachs says the S&P will hit 4,300 by the end of the year, up another 5%. Many of the market bulls do concede to the potential of the economy overheating, but with inflation, it's not clear to me that stocks should go down. Equity ownership of companies is still one of the best places to be, as Mr. Roche said, since higher prices in the economy from inflation would benefit companies who are selling their products and services at higher prices. You don't want to be in bonds or cash that have capped returns during an inflationary environment. But as Jeremy Siegel noted, if the Fed starts to lean in really hard to control inflation, it would certainly hurt the equity markets with much higher rates. But that does not look like it is on the horizon at this point. Fed Chairman Powell has been very clear that he will be following a dovish policy for the foreseeable future. So, while the market has had a big move higher over the last year, it certainly seems like there are factors supporting ongoing gains in the market.
Okay, great report, Nicole. By the way, we can all be witness to Nicole's attestation of her predictions from past KingCats, right? So there's recordings to affirm that for sure. So a little a slap on the back there, Nicole. Also, really stunning stat about the new money flowing into the market in the past 5 years compared to the past 12 years. Just stunning, almost like the gamification of the equity markets. And then I started that segment by saying, don't put any new money to work. And then Nicole went on to recite all these really, really expert people indicating just the opposite. So I'll leave it to you for that. But a quick question for you, Nicole. You talked about how Scott Minor expects interest rates to go negative. Tell our viewers about negative interest rates. What are they?
Yeah, so essentially with negative interest rates, borrowers are actually credited with interest rather than paying interest. And this is with the goal of encouraging lending, spending, and investment. And so those with their money in safe places would earn a lower rate of interest. And so they would be incentivized to likely save less and invest in riskier assets that have a higher expected rate of return.
Good. And of course, this ties into the economic concept of opportunity cost, right? If interest rates are negative, the opportunity cost of holding cash is obviously zero. And so there's an incentive to spend, right? Negative interest rates are to induce us to spend our money rather than to save our money. All right, great as always. And, we could have picked 100 different hot topics, but there was really another hot topic this week. President Biden coming out to talk about his efforts to control guns in America. And of course, it's a hot topic given the recent shootings. Lily Ryan spent some time delving into President Biden's intentions using the executive order rather than legislation at this point to take on this pressing issue. Lily, tell us what you find out.
Yeah, so President Joe Biden announced a series of executive actions aimed at reducing gun violence, among them a ban on assault rifles and high-capacity ammo magazines, while urging Congress to pass broader gun control legislation. Biden's plans to combat gun violence are unveiled because of the recent mass shootings across the country, including the deadly attacks in Georgia and Colorado. The massacre in Boulder reignited the debate in Washington over how to approach the topic of gun violence in the US. President Joe Biden is trying to limit ghost guns, which is a term for a homemade or improvised firearm that lacks commercial serial numbers. And he's also trying to make it easier for people to flag family members who shouldn't be allowed to purchase firearms, with a series of executive actions taken in the wake of the recent shootings. Biden said he wants kits and parts used to make guns to be treated as firearms, where the parts have serial numbers and are subject to a background check. On Thursday, Biden said gun violence in this country is an epidemic and it's an international embarrassment. The White House's moves include directing the Department of Justice to craft a rule addressing the spread of untraceable ghost guns and publish an example of red flag legislation for states to follow. Biden also announced he would nominate former federal agent David Chipman to head the Bureau of Alcohol, Tobacco, and Firearms. Chipman is a senior policy advisor for gun control advocacy group Giffords and has 25 years of experience as an ATF special agent. Here's what Biden's plans will do, according to the fact sheet from the White House. It will direct the Justice Department to propose a rule within 30 days to help to stop a proliferation of ghost guns, direct the DOJ to craft a rule within 60 days that clarifies the point at which a stabilizing arm brace effectively turns a pistol into a short-barreled rifle, subjecting that firearm to additional regulations, direct the DOJ to publish within 60 days model red flag legislation, which lets law enforcement officers or family members ask a court to temporarily bar someone from accessing guns under certain circumstances. The White House says the model legislation will make it easier for states to pass their own versions of that law. And finally, direct the DOJ to issue a comprehensive report on gun trafficking. The actions by Biden are limited and will likely face legal opposition from gun rights advocates who view any efforts to limit access as a violation of the Second Amendment. The administration also aims to focus investment in community violence interventions, which are methods for lowering gun violence in cities without incarcerating people, the fact sheet said. Some metropolitan areas, such as New York City, are grappling with a surge in shooting crimes and homicides amid the coronavirus pandemic.
This is going to cause dismay for the strict advocates of the Second Amendment and others who support the right to own arms. And so we can expect some pushback here. Of course, the NRA comes to mind right away. And so a question for you, Lily. For those in Congress who disagree with the president's actions, and again, I'm not a huge fan of the executive order, be a Republican or Democrat. I think we should go through the legislative process, but whatever that is, for those who oppose this executive action, is there something they can do about it?
So if the Congress disapproves of an executive order, they can write and pass legislation that could reverse or overturn it. And because Democrats control the Congress, if the Republicans wanted to, they could take President Biden to court to challenge the executive action.
Okay, so this is something that's been with us on a regular basis, right? We've had this recent spat of shootings, just another one just the other day by a former NFL football player. Really sad stuff for sure. And so this is something we'll be dealing with as a society for some time, and the debate will go on. Don't forget, states will want to be involved in this as well. All right, great hot topics as always. Thank you very much for those great reports. All right, now it's time for our guest segment. We have an outstanding guest today, Mr. Dean Maki, Chief Economist at Point72 Asset Management. A really great get this week. This is going to be a must-listen to interview. Before joining Point72, Mr. Maki was Managing Director and Chief U.S. Economist at Barclays Bank from 2005 to 2014, a place I once worked. He previously worked as a Vice President of Economic Research at J.P. Morgan Chase, responsible for forecasts of Federal Reserve policy, the federal budget, and Treasury debt issuance. Early in his career, he worked as a U.S. economist at Patten Investments and was a senior economist at the Federal Reserve Board, where his research focused on the relationship between household balance sheets and consumer spending. Mr. Maki earned a PhD in economics from Stanford University and a BA in economics from St. Olaf's College, from which he received an Alumni Achievement Award. He is a member of the Economics Club of New York and is a former president of the Forecasters Club of New York, as well as a former president of the New York Association for Business Economics. In 2013 and 2016, Mr. Maki received the Lawrence R. Klein Award for blue chip forecast accuracy for being the most accurate overall forecaster of the U.S. economy over the previous 4 years, finishing ahead of approximately 50 of the nation's top economic forecasters. Really impressive resume. And joining us now is Mr. Dean Maki. Good morning, Dean.
Good morning, Frank. How are you doing?
Great to see you. Thank you so much for joining us today.
Sure, happy to do so.
Dean, I just did a wonderful introduction. We're talking about your outstanding forecasting abilities. And so we're going to ask you some questions today. And before we let you go, we'll ask you to give us a little bit of forecast for the U.S. economy. Dean, I want to start us off with a quick question on federal debt. Total federal outstanding debt reached $28 trillion as of yesterday, up nearly $20 trillion since Q3 of 2001. The federal government is living way beyond its means, as are most governments around the world. There don't seem to be any more deficit hawks left in Washington, D.C. So I just want to ask you a simple question. Dean, does debt matter anymore?
It does matter, but it's hard to tell that from looking around the world right now. And I think there has been a shift within the economics profession in terms of the emphasis that people have put on the deficit and debt in total and how scary that might be. You have very prominent economists saying we should spend a lot of money right now. We shouldn't worry about the debt right now. And I think the test ultimately comes down to, are people willing to finance that debt? And right now, interest rates, while they've gone up some, are still quite low. And that's going to be the real key over the next few years. If interest rates do stay low, then we will be able to manage this debt without much problem. I think the scary scenario comes when interest rates rise substantially. That makes the deficit even worse. And that's then everything starts to break down in this very nice world we live in right now, where we seem to be able to borrow as much as we want. So I think that's the key to watch going forward.
Very often, most inflection points in the economy are credit events. Is that fair to say?
Certainly, that's a big reason for a lot of them. Once in a while, it's a stock market decline that prompts reevaluation of things, but often it is credit that drives recessions, for example.
Dean, some of my younger students' interest in economics and the world around them suggests this might be generational theft. What do you think about that idea, that we're imposing burdens on future generations?
Well, certainly we are leaving a lot of debt for future generations. There's no question about that. I think it comes down to, are we using the money we're borrowing productively? If we're using it to make the economy grow faster so that we have more wealth as a country, then it's worth it. If it's well invested, then and we're leaving an economy and wealth to our heirs that is adequate and that is enhanced by this borrowing. On the other hand, if we're using it to go on nice vacations and do all that, and that's what the debt ultimately is for, then it's not so good to leave on to others. So really it comes down to, are we investing wisely?
Dean, I have with me my team today, Jake Murphy, Lily, Ryan, Nicole Roer. They're anxious to actually ask you some questions. Jake, why don't you go ahead and get started?
All right. Mr. Maki, in connection to Mr. Roche's question, the Fed has expanded their balance sheet to $7.7 trillion as of April 5th, up from $4.2 trillion in March of 2020 and from $850 billion in 2008. Is this something Americans should be concerned about? And does this imply that the Fed is monetizing federal debt?
So that is a loaded term. I mean, technically, that is exactly what's happening. It's the Fed's allowing the government to borrow. They wouldn't use that term exactly. They'd use other terms, but certainly the Fed is allowing the government to borrow at low rates. And that's, the government is borrowing, as Frank mentioned, the government is borrowing a lot right now, and the Fed's allowing that to happen. I don't think the Fed balance sheet itself should be the main worry for people right now. I think the main worry is really, is the borrowing that we're doing and the easy policy led by the Fed, is that going to lead to an inflationary outcome? If it does, then this all has to change. The Fed has to clamp down, raise rates, the economy has to slow down, probably ultimately go into a recession as a result of that inflation. If, on the other hand, as has been the case the past couple of decades, inflation stays low, then I don't think we really should be worried about that Fed balance sheet. So by itself, the Fed balance sheet doesn't do anything problematic. Really, the things to worry about are inflation. The other things to worry about are asset bubbles that come out of very easy policy environments.
Lily?
Mr. Maki, the moratorium on rent, lease, and mortgage payments is set to expire soon. What do you expect to happen? Will this cause another economic downturn? And do you have a sense of how much money is owed to landlords and banks?
I haven't seen reliable estimates of exactly how much money is owed at this point. But it is a very large number, no question, because we've had these moratoria that have allowed people to stay in their place without paying rent if necessary. It is something that concerns me. I think the reason I don't think it's going to cause a downturn is that we have so much stimulus going in other ways right now. The federal government's spending a lot of money over the next few months, over the next year, actually. They're likely to pass an infrastructure bill, which means even more money is going to be spent. The Fed is running very easy policy. That combination, we think, is going to cause growth to speed up, not slow down. And I think there will be difficulties without question when these moratoria are lifted. And it is something that I worry about, particularly for households, but also, from a financial perspective, there are people that are going to be exposed to, the small landlords, for example, that haven't been getting rent. They do need to get paid in some way or another for their properties. So I do think this is going to be a difficulty, but I don't think it's the type of thing that's going to lead to a recession, given all the other policy stimulus that we have.
Hey, Dean, in economics, we teach the circular flow diagram. Has this disrupted the flow of money through the system?
It certainly has. And because I think the way to think about it is, first of all, the big shock, let's not forget, the big shock is the COVID shock, and that caused people to lose their jobs. That caused people not to pay their rent. That then caused landlords not to get paid. All of those people are spending less money than they would have otherwise because of a lack of funds. So it certainly has been a disruptive event in that sense, and will be going forward as well until we get back to something like full employment where people are fully employed again. So it has been that kind of disruption that you're talking about.
Nicole?
Mr. Maki, the Producer Price Index for the month of March was released on Friday, showing a year-over-year increase of 4.2%, well above the Fed's inflation target of 2%. If we see strong signs of inflation pressures continuing to rise, how do you think the Fed will handle it, given their pledge not to raise rates until the end of 2023?
Well, the Fed has told us that they're expecting a near-term rise in inflation. And Fed Chair Powell this week talked about the difference between a one-time increase in prices and ongoing inflation that happens year after year after year. So the Fed is expecting this year to show higher inflation, even on their preferred measure, which is the core PCE price index. They expect that to be above target by the end of the year. And certainly almost everybody expects it to move above target over the next few months. So we are going to see inflation rise. The real question then becomes, is inflation also going to be higher next year, not just this year? Because there are disruptions in the economy, there's supply chain issues that are making goods more expensive. And that rise in prices is exactly what we're seeing in that producer price index that you mentioned. That should pass through to consumer prices as well. The real key is going to be, how long does this higher inflation last? If it does turn out to be transitory, the Fed will just look through it and they won't change their policy at all as a result of this. However, if next year we're seeing the core PCE price index rise to 2.5% to 3%, then the Fed's going to start thinking harder about tapering their asset purchases and ultimately raising rates at some point down the line.
Dean, do you have any concern that inflation expectations may become unanchored?
I do think that's a risk in this environment because you could, if you wanted that to happen, you couldn't ask for a better scenario for that to happen. In the sense that the federal government is spending money like never before, the deficit and debt are higher than ever before, the Fed's running an easier policy than ever before, and they're telling us they're going to be easy for the next several years. That's about as inflationary policy as you can possibly construct. And the Fed, not only that, the Fed tells us they want inflation higher. And so they're encouraging expectations to rise and inflation to move higher. I do think that's a risk. One thing I would say, though, is I'm not as attached to the idea that ultimately the only thing that matters for inflation is expectations. That is kind of the current thinking in academia in terms of the inflation process. And I think it's correct as far as it goes, but I think the thing that people often forget is that most of the time expectations lag inflation. So if we have high inflation over the next couple of years, inflation expectations will rise. It's not as though we can just look at those and say, well, yes, inflation's high, but expectations haven't moved up, so we don't have to worry about it. I do think ultimately they will follow the inflation higher. So I do think that's a risk over the next few years.
It reminds me of some great lines from the economics classroom, Dean, which you may recall. Too much money chasing too few goods. And Dean, why hasn't the Fed taken away the punch bowl? They were supposed to take it away some time ago. Remember that line?
That's right. They're running a good party right now. They're not taking away the punch bowl at all.
That's right. All right, Dean, one more question. We could keep you all day. Thank you so much for your time. There's lots of talk of pent up demand and people excited to be released from lockdown. What is your near-term outlook for GDP growth, employment, and inflation?
Yeah, so I'm quite optimistic on GDP growth over the next few quarters. For the first quarter, I think it's going to be 5% growth, and then picking up to 8% in Q2 and Q3, then slowing down a bit to 5% in Q4. And if anything, there's probably upside risk to those 8% numbers. So the near-term growth outlook looks very strong, and it's just a matter of how strong we get. I do expect that inflation is going to rise over the next several months, even if for no other reason than base effects. We had a very low inflation a year ago after COVID. As we compare those on the year-on-year numbers, the inflation numbers are going to rise year-on-year over the next several months. I think then inflation settles down through the rest of the year to a pace that will not cause the Fed to taper or to even or to think about raising rates anytime soon. So I think the inflation outlook ultimately will prove subdued enough for the Fed to keep its easy policy in place this year, and probably next year they start to taper. All of this means that long-term interest rates are likely to move higher this year as the growth numbers get very strong. Inflation picks up over the next several months. But I think the short end of the interest rates are likely to stay anchored by the Fed staying on hold.
Dean, we're going to let you go. Thank you so much for your time. I think this will be a real treat for the whole King community to hear your expert insight into the state of the economy and what's coming forward. All the best. And we can't let you go without mentioning, of course, you're also the dad of the 2019 alum, Ari Maki. Hope he's all well. Tell him we said hi.
I definitely will do that.
Thank you, Dean.
Thanks for having me on.
All right, so thanks so much for Mr. Dean Maki, Chief Economist at Point72 Asset Management here in Stanford. Great insights, really well-respected economist. A real benefit for all of our listeners here this week for sure. Okay, now it's time for our fun segment.
What did we learn this week?
All right, I'm going to start us off this week, okay? I learned something this week. So in my money markets and economics class, we're moving to our research unit for the next few weeks. And I'm encouraged, I need all my students on Excel where we use their data package, all their stochastic tools to run regression analysis and some other things. And some of the students didn't have Excel. And so they have Google Sheets. And I learned this week that Google Sheets, while not as good as Excel and their data tools, does have some data tools that we'll be able to make use of. So that's what I learned this week. How about you, Nicole?
Well, just to comment on that for a second, Lily and I have had the long debate from, tracking data in our econ class that I use Excel and she used Google Sheets. And my spreadsheet has deleted a good number of times, and Google does save everything in, their Google Drive. So I will give her a point there, but otherwise I think Excel is much better.
Okay.
So my AP Lang class taught by Miss Patten, we finished In Cold Blood by Truman Capote, and I highly, highly recommend the book to anyone looking for a really good murder mystery. But what I learned through the book is something called the McNaughton Rule, which basically says that regardless of any other possible mental health conditions, if a criminal can tell the difference between right and wrong and could tell that their crime was wrong, then they are to be considered sane in a court of law and can be convicted of the crime. And it's still the standard of insanity today in almost half of the states.
Okay, that's a good one. Okay, Miss Patten. Lily, what'd you learn this week?
In Mr. Nelson honors physics class, we talked about circuits and more specifically the difference between a series and parallel circuit and the number of paths.
Okay, I don't know what that means at all, but whatever. That's why I teach economics. Jake, what'd you learn this week?
Mine is also from the physics classroom. This week, we spent a lot of time talking about collisions, and we basically just spent the whole class we had this track with these little like train looking things on them, just basically throwing them together, throwing metal balls at them. It was a lovely class.
Okay, that's great. The bottom line is it fits into our friendly reminders, right? Stop signs mean stops, don't change lanes.
Yes.
Collision, right? Okay, good. All right, and that is.
What did we learn this week?
Okay, now it's time for a little bit of King things. Nicole, start us off.
The upper school and middle school will return to 5 days of in-person learning the week of May 3rd. The start time on Wednesdays will be 9 a.m.
Love it.
As a part of King Reads Together series, hear from Dr. Lisa Damore on April 21st at 7 p.m. Dr. Damore will explain how stress and anxiety operate across all ages and developmental levels, both under everyday conditions and at times of heightened disruption.
Course requests will begin next week. Parents and students will receive specific updates via email, and the courses are published in My King.
Of course, all course requests should include an economics class, period, right? You can't go through King without taking econ. AP economics, micro, macro. We have international economics coming up. We have money market and economics. We have public, what do we have? Principles of macro and micro, really one semester course. Okay, that's enough. All right, that's our King things, what's happening in our great King community. We do not have Jake and Rahill with us for sports today. However, Nicole and Lily are talking to us about basketball and hockey. Start us off, Nicole.
The NCAA college basketball tournament ended earlier this week with Baylor trouncing Gonzaga 86-70 in the men's final and foiling the Bulldogs' chance to have a perfect season without any losses. The tournament was filled with upsets from the start in the round of 64. 9 double-digit seeds advanced to the round of 32. Baylor point guard Jared Butler was named Most Outstanding Player after scoring 39 total points in the Final Four. On the women's side, it was a thrilling final, with Stanford beating Arizona by just 1 point. I had a lot of fun participating in the King March Madness bracket tournament, but ultimately it was Mr. Boaz who triumphed over the rest of us, so big congratulations to him as well. In the NBA, the playoffs are about a month away. Top contenders for the title this year are the defending champions, the Lakers, and the Brooklyn Nets, with the addition this year of KD, Kyrie, and Harden. There are also some unexpected teams such as the Phoenix Suns and Utah Jazz, who are at the top of the Western Conference, and not surprisingly, the 76ers and Bucks near the top of the Eastern Conference. While Miami is ranked 6th in the East, don't count them out of making it to the finals again. In golf news, the Masters got underway on Thursday, and Justin Rose from South Africa got out to a quick start with an opening round of 65 strokes, 7 under par, but a more shaky second round at 72. Rose has won 10 PGA tournaments in his career, but nothing in the past couple of years. After 2 rounds, he is 1 stroke ahead of Americans Brian Harman and Will Zalatoris, and 2 strokes ahead of Australia's Mark Leishman and American Jordan Spieth. Still 2 more rounds to go, and it will be exciting to see what happens this weekend. Now, over to our expert on the NHL, Lily, take it away.
Thanks, Nicole. So unfortunately, over 25 members of the Vancouver Canucks have tested positive for COVID-19, and more specifically, the Brazil variant. Based on the number of positive tests, it is unsure how they'll play an equal amount of games as other teams and when their games will resume. Since the last KingCast, the Buffalo Sabres happened to experience one of the longest winless streaks in the NHL, which lasted 18 games. This excruciating streak ended with a win over the Flyers. As the trade deadline comes to a close on April 12th, some notable moves have happened. NHL veteran Eric Staal was traded from Buffalo to Montreal. Fourth liner Brendan Lemieux was traded from the Rangers to the Kings. And Jimmy Vesey was traded to the Canucks by the Maple Leafs, where he will hopefully get more playing time. And this week, I'm going to do a player highlight. So Adam Fox is a 23-year-old defenseman for the New York Rangers. He is currently tied with Victor Hedman for first in points and first in assists across all NHL defensemen. And unfortunately, last night against the Islanders, he broke his 12-game point streak. He currently has 37 points in 39 games, and as of right now, NHL.com has him winning the Norris Trophy compared to the other Eastern Division candidates. On April 10th, the Rangers faced off against the Islanders, and Alexander Georgiev returned to goal on Friday against the Islanders, saving 31 shots. The last time he started was a game on March 19th, which makes sense considering how well Igor Shesterkin is playing. The Rangers really needed this win due to their loss against Pittsburgh the night before. The final score was 4-1 with goals from rookies Alexis Lafreniere and Keandre Miller, along with Colin Blackwell, and with an empty net goal from Mika Zibanejad in the third period. The Rangers are getting closer to clinching that playoff spot, so the remaining games will be very important.
Okay, great. 2 great reports. Covered a bunch of sports there. Really well done. I'll be watching the Masters this weekend. Oh, no. I don't think Jack and Rahill are going to want to miss another KingCast. Uh-oh. We shouldn't let them watch this KingCast. No, I'm kidding, of course. They'll be back with us. We may do something a little different with Jack and Rahill because Jack has a conflict. But for the next couple of weeks, we'll be together. And, of course, Lily and Nicole continue their sports world as well. All right, thank you so much. And that is sports. Now it's time to move to the economy and markets. We'll start off with a little hot topic by Mr. Jake Murphy. By the way, Jake, you look good today with that light, buddy.
I know, right? I was really excited when I got here, test it out. All right, so my story is about Archegos capital management and what happened about a week and a half, 2 weeks ago. So late last March, investor Bill Wang created chaos on Wall Street when his firm, Archegos Capital Management, started selling off massive positions in blue chip stocks. This caused huge damage to several banks, and Credit Suisse said they suffered a $4.7 billion loss. So what exactly happened? Let's start with Archegos Management, the family investment vehicle owned by Mr. Wang. Archegos describes itself as focused on public stocks in the US, China, Japan, South Korea, and parts of Europe. In recent months, it played a part in the rally of shares of Viacom, Discovery, Fairfetch, and New York listed Chinese stocks like GSX, Tencent Entertainment Group, Baidu, and others. Now, Archegos took big concentrated positions in companies and held some positions via something called total return swaps. Those are contracts brokered by Wall Street banks that allow a user to take on the profits and losses of a portfolio of stocks or other assets in exchange for a fee. So why did Mr. Wang risk it all by using credit swaps? Well, it's because it allowed him to buy up incredible amounts of stock, up to 10% of some companies, which would normally subject him to further regulation, but all this anonymously via multiple banks. So what started the chaos? Well, on March 22nd, Viacom announced a sale of common stock, causing their price to start falling gently. However, when the banks noticed this, they decided to pull the trigger. Now, because all of Mr. Wang's stocks were held in swaps, the banks had full control over them, meaning that when the stocks started to fall naturally on their own, all these banks began to sell massive positions, not knowing that they're all owned by the same man. This caused a domino effect of prices falling and more banks selling. Credit Suisse was the last to abandon ship, causing them the most damage. Pretty crazy stuff.
Yeah.
Super interesting.
Yeah, and that's a very common theme in markets. The first one to get out gets hurt the least, right? The last one out gets hurt the worst. And once the markets become aware of what positions have to be sold and they know someone's on the hook, it's even worse. So a great story. You had a little tongue in cheek in there as well, Jake. A little smile on your face. Hubris, a little bit of hubris there, taking down some very wealthy people. All righty, let's move on to our data and markets. This is data for the week ending April 9th. Start us off, Nicole.
So on Friday, March Producer Price Index up 1% versus up 0.5% in February. And as I mentioned when Mr. Maki was here, the PPI was up 4.2% year over year, the highest percentage gain since 2011.
On Thursday, we have initial unemployment claims week ending April 3rd, 744,000 for 728,000 in the prior week.
MBA mortgage applications week ending April 2nd, down 5.1%. Versus down 2.2% in the prior week. In February, international trade in goods and services minus $71.8 billion, new record trade deficit versus minus $67.8 billion in January.
On Tuesday, no data.
On Monday, February factory orders down 0.8% versus up 2.7% in January. In March, ISM non-manufacturing index 69.4 versus 55.5 in February.
Okay, a little review. The obvious highlights for the week were claims still in the 700s, not good. MBA mortgage applications 4 weeks in a row, 5 weeks in a row of negative number, not good. That's a home affordability issue. And of course, a record trade deficit in goods and services, not good for us. Okay, how about for this week beginning April 12th? What do we have for data this week, Jake?
Monday, March federal budget balance.
Tuesday, March Consumer Price Index.
Wednesday, MBA mortgage applications week ending April 9th.
For Thursday, initial unemployment claims week ending April 10th, April New York Empire Manufacturing Index, April Philadelphia Fed Index, March retail sales, March industrial production and capacity utilization, and February Treasury international capital flows.
On Friday, March housing starts, in April, University of Michigan consumer sentiment.
Okay, now let's check in on markets. Now this is going to be interesting. Okay, so the change here we're going to cite is the change from our last show, which was back in early March. Okay, so this is not week over week. This is weeks over weeks. All right, Jake, start us off.
S&P 500, 4,128.80, up 317 points.
The NASDAQ, 13,900, up 708 points.
3-month Treasury 0.015%, down 3 basis points.
10-year Treasury 1.662%, up 26 basis points.
30-year Treasury 2.336%, up 18 basis points.
Euro dollar 1.19, down 170 pips.
Dollar yen 109.65, up 305 pips.
Sterling 1.371, down 220 pips.
Dollar CAD 1.2520, down 220 pips.
West Texas Intermediate oil, $59.34 a barrel, down $2.32.
Brent $62.95, unchanged.
Gasoline $1.96, up 1 cent.
And gold, $1,744.10, up $11.
Okay, so that was a risk-on period of time from the last time we're on the air till today. Buy equities, sell commodities, sell dollars. Okay, so stronger equities, a little higher interest rates, weaker dollar, a little bit convoluted there for that period of time. All right, let's finish up the show with our friendly reminders.
Do your reading.
Do your homework.
Come to class prepared.
Use your blinker when making turns or switching lanes.
Stop signs mean stop.
And no texting while driving.
Exactly, that is it for us. Thank you to our team, Jake, Lily, Nicole. We miss Rahill and Jack. Join us again next week and tell your friends and family to listen to the Kingcast at kingschoolct.org campus life page. We're out of here.